Hello and welcome to Macros with Mythili, our weekly show where we take a hard look at major macroeconomic developments and issues in India and overseas. This week we're going to look at the banking sector, in particular the Finance Ministry's recent meeting with public sector bank heads to try and get stalled projects moving and enthuse banks to start lending again. And to do this, we have two of the best brains on the banking sector with us. We have Santosh Nayar, CMD, IIFCL, who brings with him hands-on experience of financing infrastructure projects. We also have Ram Mohan, economics professor at IIM Ahmedabad, who's been tracking the banking sector for long. Welcome to the show, gentlemen. TTR, if I may start with you, as an academic, perhaps you can give me the most dispassionate view of what can we do to get the huge amount of capital that is locked up in these stalled projects moving again. After all, for a capital scarce economy, it could be nothing worse than having projects half done with neither the banks willing to lend anymore nor the promoters willing to bring any more money, and government seems to have its hands tied. So how do we unlock the entire rigmarole?
Well, I think there are two different things that need to be done. The first is that you have to address a range of issues related to the real sector where the assets are locked up. So that means getting the land acquisition clearances, getting the environmental clearance, getting the fuel linkages in place, all the issues that we have become familiar with for years now and which have remained unresolved for one reason or the other, and which perhaps cannot be tackled in a very short frame of time. So that is one set of issues that you need to address. But the other issue that you need to address is the infusion of capital into banking, because no further lending can take place and you cannot finance infrastructure unless you have adequate capital. And in my view, this is perhaps the single biggest failing in the banking policy so far, in policies related to the banking sector, which is that for one reason or another, government has been shy of infusing adequate capital. So last year they promised about 11,000 crores and ended up infusing about 7,000 crores. And this year the allocation is just about 8,000 crores, when by any reasonable reckoning, you need 20,000 crores minimum of capital into public sector banks every year for the next 5 years. So, under the new capital requirements, banks will have to operate at a minimum capital adequacy ratio of about 10.5%. And most bankers understand that in order to be able to lend freely, you need a margin of about 4 or 5% over there. So you need a capital adequacy of about 14 to 15% to be able to lend freely. And you cannot expect infrastructure to get moving, until banks have that level of capital, and we are nowhere near that now. So I think the failings are very fundamental, whether in relation to the problems of the real sector or whether in relation to the capital requirements of the banking sector. And I don't see any initiatives which can fundamentally change either of these.
Santosh, you've been, both a commercial banker in your days with State Bank of India and now as CMD of a term lending institution specializing essentially only on infrastructure financing. What do you see as the crux of the problem? Are banks the only ones responsible, or is it a whole host of things, the entire system, as TTR put it, or is it the lack of capital? If government were to pump in more money, will that solve the issue? What is your sense? How do we get out of this mess that we find ourselves in?
I don't know whether you can say somebody is not responsible, because I think the fact that so much infrastructure has come up in the country is because people were responsible. It's just so happened that a lot of things went wrong in the last 3-4 years, and things which were not anticipated by the project implementers or developers or by the lenders or even by the government. For example, when we started lending with infrastructure projects, things were looking good. And nobody really anticipated that GDP growth will fall, the estimates will go wrong, the traffic will come down. Further to that, because infrastructure lending primarily, it was quite new to most of the lenders. It really picked up in 2008, 7, 8. And we didn't have that kind of exposure to what could go wrong, So we never anticipated, as a lenders, we never anticipated that, there will be so much of delay in land acquisition. There could be so much of delay in environmental clearance particularly. That we have provided for variation in cash flow, but not to the extent we ultimately what happened, and the fact that some laxity on the part of lenders to when you assume that a lot of things will happen because the promoters were very successful in the past in various other projects, that same thing will hold good for infrastructure ventures also. As a result of which the gearing went high, and when the promoters got into problem, they had to borrow further. this worsened the gearing, and when the cash flow deteriorated, this added to the problems. So this is really what happened. Right now, when I was made chairman of this committee on power sector recommendations, my argument was that, at this current stage, India cannot afford to lose the capacity which has been built up, all viable capacity, that is. For a country like India, which is still in the development stage, losing a capacity can be a very big blow, simply because, the replacement cost will be much higher. There will be a time cost to the whole thing, because, a power project takes about 3-4 years to come, and if we let the capacities go, then, replacing it same will be minimum 3-4 years, provided there are developers and banks willing to lend more, which may not be the case. When all these projects become NPA, the developers will be reluctant to come into the sector, and even if they come, they will not get the money. And additionally, the banks' balance sheet are going to take a big hit, which already they have become hesitant to lending to infrastructure. That will create further problem for them. This is the issue. So I think protecting the capacity which is already created, all viable capacity. I mean, we can decide who should take a hit, how much lenders should take a hit, or the promoters should take a hit. But ultimately, I think from a country's point of view, we should do whatever we can to see that the capacity is protected.
TTR, you spoke about capital being a major constraint, but the government has recently adopted what I would call a slightly strange policy with regard to capital infusion into public sector banks. They say that they will give capital only to those banks who perform well, whose return on assets, whose return on equity, is above a certain benchmark, as they put it, and not to other banks. To my mind, this sounds like a father telling two children that, the child who performs well academically, only he will be given a good lunch or food at home, whereas the other child will have to starve, because ultimately it hurts the father as much as the child. So a government, as the owner of the bank, will it not have to take the onus or responsibility for both kinds of banks and do something about improving their return on equity, improving their return on assets, rather than denying those banks that are already not in a good shape any further capital? So is there something wrong with government's approach that it takes a very theoretical view of capital infusion to public sector banks? Because after all, during the slowdown, it was the public sector banks which lent aggressively to infrastructure.
Yes, I think you put it very well. I couldn't have put it much better, and it is a bit of a puzzle. I mean, why government has adopted this kind of policy, where it says that it will only give to the well-performing banks, and it will be very miserly with giving capital to banks which have not been doing well. Now, all of us understand that regardless of how a bank has performed in the past, if you want the bank to perform in the future, you have to have that minimum requirement of, you have to have the minimum amount of capital. I mean, if this principle were not accepted, we wouldn't have all this bailout of banks. So, we have had banks during the financial crisis whose entire capital was wiped out, and the way governments got them going was to infuse fresh capital into them. So if this applies to failed banks, it certainly applies to underperforming banks as well. Now, it may well be that the government doesn't intend to let these banks function on a standalone basis for more than a few years. They would like to sell some of these banks, or they'd like to merge them with some of the stronger banks. But if that is even if that is the intention, purely from the point of view of getting a better valuation if you're selling it to private buyers, or in the interest of having a healthy merged bank, if you're merging with a strong bank, you still need to provide capital to these banks. So the logic, if any, of denying capital to a whole set of banks until such time as they perform well is a complete mystery to me. And I can't see the banks performing well unless, the government releases its purse strings. So as I said, I mean, this is a significant failing, and the logic of it is something which defies my comprehension at least.
Oh, well, absolutely, yes. It's very difficult to find reason in a lot of government's actions. But I'm afraid on that note, we have to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the problems in the banking sector and what can be done to get stalled infrastructure projects off the ground and get banks to lend once again, with both Santosh Nayar as well as Ram Mohan. Santosh, you had headed a committee, an expert committee, on what are the problems in the banking sector and what needs to be done to get all these stalled power projects off the ground again. And you'd made a number of recommendations. Have these recommendations been implemented, and to what extent has that really led to any kind of revival of lending in the power sector area?
You see, we had given some 22 recommendations, and a number of them RBI has already implemented. Some of them they have said that they are considering. But these have been done on a one-off basis, one recommendation now, one recommendation later, instead of looking at the whole thing in a holistic fashion, I feel. Probably I think after yesterday's meeting they decided to take the relook at the entire recommendations. And the most important thing was, of course, that 5/25 scheme, which initially was made only for the for prospective, which they made it now retrospective. Because in my opinion, when I discussed with RBI also, I was suggesting that you know, the people who need this equally or even more is the projects which are already under implementation or has been implemented. And if you don't make it for the projects already under implementation, they will be at a permanent disadvantage. You know, many of the projects are actually suffering because Indian banks followed a slightly wrong lending policy. I mean, they lend to project financing exactly like they do a normal term loan, which means, you know, you say my deposit profile is 5 years and therefore we don't lend more than 10 years. Now, when the project becomes very large and takes 4 or 5 years to implement, and with all these problems, it takes 5 or 6 years, then asking them to pay back in 5 or 6 years is a next near impossible thing, you know, that automatically they will come for restructuring. And now from this year onward, there is no such thing as restructuring, or it becomes NPA, which means the lenders will hesitate to lend to such projects when they know that they can't pay back in 5 or 6 years. Now, this 5/25 solved this problem by extending this amortization of the asset life and also giving the refinancing mode for every 5 or 6 years. This is the way internationally project financing loans are done. So we are just moving to that stage. Another important issue which probably has not been resolved, which is which the lenders as well as the developers say is the crying need, is that RBI has put a cap of 10% on the the cost of refinancing which can be financed. Over and above 10%, the developers has to bring the money. Now, in very large projects, it's very difficult for developers to bring that kind of money. So, with the result that most of the projects where even the lenders feel or the developers feel with some restructuring or additional financing this can become viable, those projects are now frozen, and they will absolutely become NPA, and the capacity will be wasted if you don't amend this thing. Because to me, my committee, we recommended that it should be looked on a case specific basis. If it's 8%, it should be 8%. If it's 12%, it should be 12%. Let us not put an arbitrary cap of 10%. Let the lenders decide after the due appraisal and all, if the project is viable, what they should do. I think this recommendation probably even now the lenders and developers are coming back and saying that this is actually the most critical thing, which probably we need to look into.
No, absolutely. I think you had also made a couple of other recommendations. I'm looking, in fact, of quoting one of your recommendations, that the extension in buyer's credit period from 3 years currently to 5 years without needing specific RBI approval. Now, this seems to be a very logical kind of recommendation. Has this been accepted by the RBI? And if not, does the RBI tend to take a slightly theoretical view of things? And even if you talk about the removal of forbearance from the 1st of April, is that also not being slightly textbookish in its approach? Does the RBI needs to get a little more real, and wherever forbearance is required, leave it to the banks as long as they have a convincing case? After all, the RBI has its own inspection. So wherever it feels there was something wrong, with the reason for lending, where they feel there's something fraudulent, where the banks are also conniving with the promoters, there might be a case for the RBI to intervene. But this kind of very blanket, textbookish approach about forbearance, does it really smack of a regulator who is not really very clued into the grassroots reality?
No, you see, as a regulator, you can't say that they are taking a very theoretical view, because in my opinion, my practice experience, RBI has recently come out been very proactive in many things, and they also has to please remember, they also have to wear a regulator's cap. So they have to be very careful that the guidelines are not misutilized, and the banks follow a certain discipline. But then I think when we suggest something, they look at it, even if they say no initially when we take it up, sometimes they agree with that. Now the 3 year to 5 year was the reason, because 3 years has been there for a long time. But as the projects get larger and larger, and many times what happens is the overseas supplier of equipment will start manufacturing only after the LC is opened. And LC can be opened only after the financial closure takes place, which is about 1 or 2 years, 1 year. And then the LC, the project implementation, etc., execution normally happens in 5th or 6th year. So normally it is very important that we give the LC period to match with the project implementation cycle. That's why we recommended that it can be made to 5 years. My understanding is that whenever the individual cases are being taken to RBI, they are approving it.
TTR Santosh put up a fairly good defense of the Reserve Bank of India, but I think if you look at some of their recent suggestions, as for example, converting debt into equity. Now, this has been tried with the term lending institutions in the past, and I find from today's newspaper reports that after yesterday's meeting, the Finance Ministry and the Reserve Bank of India again seems to have told the banks that why don't you take over the management of these stall projects. Now, are banks in the business of running these projects? Are our banks lenders? Are we kind of getting a little confused about what the role of a banker is? And is that really the source of the problem?
You know, see, in any stalled situation or over-leveraged situation, you know, three things need to happen. First is there has to be a debt write-off. The second is that you have to infuse capital into the bank, which is the loser. And the third component, which is also very important, is that you have to penalize the promoter or the management in some way. So, when you're trying to convert debt into equity, or when you're asking banks to take over these stalled projects, it's the third thing that you're trying to address. You're trying to penalize the promoters in some way. Now, what has happened in many of these projects is that for whatever reason, historical or whatever, they have not had what is called enough skin in the game. You know, there hasn't been enough equity which has come in from their side. And so, what do you do in terms of penalizing them? I mean, you know, they already had very little equity. But there's a more structural issue which needs to be addressed, which is in such cases, what instruments can you have for penalizing the promoter short of taking over the project and running it yourself, which is beyond your capability? And this mechanism, which has been talked about in the last year or so, at least the last 6 months, of penalizing promoters, we have not been able to come out with a workable mechanism. So you ask the debtors, the lenders to take a hit, but there should also be some mechanism by which the people who have put in equity also take a hit. It's not that when you restructure a project, you know, the guy who has put in equity has the upside and the hit has always to be taken by bankers. Now, all people involved in this game, especially RBI and bankers, have been talking about this, but we don't have a mechanism for this. And you're right, I mean, the answer is not to ask, you know, banks to start running these projects. They don't have the management capability to do that.
Absolutely. So, Santosh, what is your view on that? Do banks have the capability to run these projects, and how can we penalize promoters to ensure that they don't walk away and ultimately leave it to banks, ultimately because it is taxpayer money and it's not bankers' own private money that comes in. So, we really do need to find some balance between penalizing the promoters and penalizing banks where necessary for wrong decisions that are wrong decisions of the bankers alone, and not because of the circumstances that really force them, you know, to pay the price for it, as it were.
Mythili, let me make it one thing very clear, that if we approach this issue currently with the standpoint that we must penalize the promoter or we must penalize the lender, then that will take us nowhere. Ideally, I think we should approach with saying that how to save this project. And if they save the project, either we have to convert debt into equity at the current market value, which means automatically the promoters get penalized because their equity gets written down, or bring new investors who will want a discount on the equity, so equity takes a write down, or the lenders have to take a write-off for the long distance. That will happen automatically when the viability of the project is being done. So, I think we should look at from the point of view, approach this issue as to how to save the projects. And then if that saving the project involves write-down of equity or write-down of debt or whatever it is, so be it. But if you ab initio say that how to penalize the promoter or how to penalize the lender, then there is that's not the way to approach, you know, when you rescue these projects. I think that is the fundamental approach we should make.
Okay, DTR, Santosh is right in a way that given the fact that there is so much of capital that is stuck in these projects and we are a poor country, we need to look at solutions. We can't talk in terms of penalizing promoters or bankers or, you know, so what is the way out? Can one think of a win-win kind of situation where ultimately it is the wealth of the country that is protected?
Yeah, I mean, I don't see any inherent conflict between saving the project and penalizing the people. I mean, you know, all of us I think will agree that unless there is some write-down of debt, there is no way the project can be made viable. So, the penalizing of the lender is built into the situation. So, when you talk about penalizing the promoter, you know, so what does the lender get in return for taking some kind of a hit? So, you know, you convert the loan into equity so that he gets something of the upside, and to that extent the promoter loses. So, you see, I mean, the penalizing of the lender and the penalizing of the promoter are built into this situation. I mean, I can't see any solution for saving the project which doesn't address both these things in one way or another. So, it's not that we start off by saying that we have to hurt this guy or that guy, but you know, that's the only solution which will be workable.
But if you look at the stalled projects, if you look at the high level of non-performing assets, particularly in the infrastructure sector, you will find a disproportionate share of the public sector banks, DTR. So, does this have something to do with their ownership of public sector banks? It was because the government almost, if not exactly, it didn't hold a gun to their head, but it was cajoling, it was, you know, coercing the banks to lend because we don't have term lending institutions anymore. So, does the solution partly because the problem lie, partly because, you know, we don't have term lending institutions, so we need to promote term lending institutions like Santosh's? Or does the answer really lie in going the Nayar committee way and getting the banks, off the public sector completely, removing governments or reducing government stakeholding in these public sector banks?
I don't think you can say that, the public sector banks erred in sort of lending to the infrastructure. Individual banks may have exceeded, prudential limits. But on the whole, if you look at the boom of 2004 to 2009, which is driven by infrastructure, it was also driven by finance provided by public sector banks. And it's interesting that the economic survey, in talking about this, it doesn't fault the public sector banks so much as the private sector banks. In fact, the economic survey remarks caustically that private sector investment has taken place in this country without any private sector financing. So, it's really the private sector banks who shied away from this kind of lending whom the economic survey faults. So, you can't say that, public sector ownership has led to this kind of funding and therefore there's something wrong with that. You see, there's a whole set of factors extraneous to the lender-borrower relationship which surface, the acquisition and clearance and other issues which have arisen, which point to major structural failings in the economy, which we need to address. But I don't think you can seriously argue that, because public sector banks lend to infrastructure, there's something wrong with public ownership per se. I think, that's a very wrong way of looking at the issue.
A change in ownership as suggested by an IIM committee, a reduction in government stakeholding is not the way forward as far as you see the problem.
Yeah, well, if you want to talk about the Nayar committee report, there are really three sets of issues related to the banking sector which we need to address. One is the issue of governance, the second is the issue of management, and the third is the operational issues which we have been talking about, infusion of capital, resolving NPAs and so on. So if you look at the governance issue, there are a couple of things which need to be addressed. First is, the composition and functioning of bank boards, and the second is the separation of the role of chairman and managing director. So the second issue has been addressed by the government in the case of some banks. They've already created posts of managing director, but they are yet to appoint the chairman. So, we have had various announcements, but we haven't seen matters proceeding to the logical conclusion because, the government's scheme of things, that takes time.
Absolutely, really. So, as far as the problems of the financial sector and the problems of the infrastructure lending in particular are concerned, it doesn't necessarily have to do with the public sector character of the PSB. Santosh, your quick closing comments on what can we really do to get out of this imbroglio?
No, Mythili, before that, I just want to add a few points to what Mr. Ram Mohan was saying. You see, probably, the management area, the board directors and all the government is already moving to rectify a lot of things and improve things. But one area probably which the banks will need to look at very seriously now, which I've been saying when I was in the bank itself, is the HR area. What happens is the banks still don't have the kind of freedom to select and, place people the way it should be. Because ultimately, although attracting people in the current environment when there are a large number of unemployed people will not be a problem for the banks because, you have lakhs of people applying for the exams. But retaining is going to be a problem because as and when the economy picks up and there is a competition for talent coming up, retaining people, particularly the right kind of people in areas like project appraisal or treasury management or international banking, etc., or risk management.
Okay, so HR is one big issue.
You need really a different kind of skill set than a normal branch manager,
So apart from HR, what else?
Yeah, this is a very big area, and I think the banks, if you want to go ahead with, minimize the risk and, avoid the pitfalls which happened in the past, they need to really relook at the HR policies. And second thing was, this the question you were asking earlier that, why did the banks lend to infrastructure? Let me just remind you that if the banks had not lent to infrastructure, particularly power sector in 2007-8, the way we did it, you and I will not be sitting in an air-conditioned room and talking now.
Well, let me just give TTR the last word. TTR, just a very quick closing comment on what is your wish list, the top of your wish list.
Yeah, you have to get the right person in as the CEO or managing director, and you have to give that person the necessary freedom to operate. Now, we have a very strange situation where for the 5 leading banks, for months together, there has been no managing director. And the government has invited applications, we are going through that process, they are throwing it open to the private sector, they are going to improve the pay scales and so on. You see, within the public sector, there are enough competent professionals who can be brought in, but this process has been completely flawed for years, perhaps for decades. So it's not beyond the ingenuity of government to select the right person as head, as CEO for these positions And that talent, let me assure you, is available within the public sector.
Absolutely. I wish the government also realizes that there is plenty of talent within the public sector, because after all, most of the private sector banks continue to be staffed and headed by people who were once in the public sector. But I'm afraid the problems in infrastructure lending are much more difficult and intractable. But on that note, I'm afraid we've come to the end of this program. Thank you so much, Santosh, as well as TTR, for sharing your views with us. Thank you also for watching. But we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.